Hello everyone, in this lesson we're going to learn how to calculate the actual value of a futures contract. In the previous lesson we learned about ticking points. For example, we saw that in the NQ futures contract, which is a futures contract for the Nasdaq index, one tick is equal to 0.25 points, which is $5, and 1 point is equal to $20. And now, since we already know exactly how much a single point is worth, we can carefully calculate the actual value in dollars of a standard futures contract. And they even write for us here on the website the formula for calculating the value of the futures contract. So in order to understand how much this futures contract is worth in dollars, we simply need to take the number of points there are multiplied by the value of each point. So let's calculate it together. We know that the value of each point is $20, and we know that right now the current value of the contract in points is 25,310. That means the value of the futures contract is $500,000 in total overall. The value of each point is $20, and there are 25,310 points. And that's how we arrive at the value of the futures contract. Now that means this value is leveraged 20 times compared to the underlying asset, and they also write it here as $20 times the Nasdaq index. That means one contract is equal to 20 units of the Nasdaq index. It is leveraged 20 times. You can see, do it right here, right now, please. And how does this leverage come into play? Do you remember at the beginning I told you a contract is the commitment to buy or sell the underlying asset? So basically, if I now buy a futures contract and its expiration date arrives, and at that point I still hold this futures contract, this I am obligated to buy the underlying asset 20 times over, meaning I have to buy the Nasdaq index 20 times. And if I were to sell the futures contract, then, and the expiration date arrives, and I still hold the futures contract, in this particular case means that I am required to sell a total of 20 Nasdaq indices. That's why we really want to be careful and not hold the contract, whether short or long, when we reach the expiration date. But don't worry, in day trading we close our open positions anyway, at the latest by the end of the trading day. And now comes the big question: how can we actually afford to pay for this in our everyday lives? To trade a futures contract that is so expensive. After all, not all of us have 500,000 shekels that we can just put into our trading account and start trading with that money. That's an amount that is just not realistic for many of us. And this is where something very, very important comes into play. It's called margin. In the next lesson, we'll explore and understand what margin is, and we'll see why it gives us the ability to trade, for example, futures contracts, even if we don't have all the money. Meaning that even if I don't have $500,000, which is the value of a futures contract, I can still trade. See you in the next lesson. Bye bye.